Welcome to Kitchen Table Finance, the podcast where we serve up bite-sized pieces of financial advice to simplify your money and your life.
Hi, Dave. How you doing today?
Not bad, Cole. How are you?
Doing all right. Trying on my Nick Nauta shoes and seeing if I can host a podcast for today.
Yeah, a little different for both of us.
So for those who don't know, Nick's on vacation this week, so Dave and I are doing our weekly podcast together. And today's topic is going to be Dave talking to a young advisor about the Great Recession of 2007 to 2009.
Memories of the Great Financial Crisis.
And for context, I'm 27. So in the fall of 07, which seems to be kind of when history starts, I think this starts to really ramp up, I would have been 10. So I don't have a whole lot of personal memories attached other than, adults in my life being stressed. So why don't you, I don't know if you have a specific plan or if you want to start there or if you want to just talk about your memories, but I think it's going to be an interesting conversation given that we're a little more than a decade and a half past it now.
Yeah. So one thing that always sticks with me is, remembering conversations with my grandparents about the Great Depression and how, that was this transformative event that they went through that stayed with them, until their 70s and 80s. We were having those conversations. And back when I was a fairly young advisor, I had a lot of clients who were still of that generation. And the effect that living through that had on financial outlooks was transcended their entire lives. And I kind of feel the same way about the great financial crisis. I can't really say was it better or worse. I guess it depends on your personal circumstances. But in terms of like the psychological effect that it had on my generation and the folks a little older than me, I think is undeniably at least on a par with the Great Depression.
Yeah, I believe that. I know that there's obviously been a number of really big financial events that happened between the Depression and between the Great Financial Crisis.
Sure.
But obviously those two seem to be kind of the big, maybe you could lump in kind of the stagflation era of the 70s in there as well. But those two really are the big, flashbulb financial memories that I think,
Right.
Americans who lived through them have and kind of financially tie some of their wisdom and their experiences to.
So here we are 16 years past the event, and it is still like it's a very useful tool as a financial planner to be able to say to someone, well, do you remember what it felt like when you looked at your portfolio and saw it was down 25%? How did you react? Like before that, it was really hard to have a frame of reference for people. When we talk about risk and portfolios, for people that haven't been through a good correction or a good bear market, if you will, it's kind of hard to really gauge like what your true emotional response to something like that is. We use it as a planning tool too, right? Programmed right into our software. We can click a button and say, well, here's how your retirement plan would look if we were talking about this in October 2007 and didn't know what was about to happen. Because it's kind of like the crash test scenario. If your plan worked out during the great financial crisis, we're probably okay. And same with our portfolio software. You can click a button and show like what that portfolio did during the great financial crisis and how long it took to recover.
I think that's really one of the better tools that we have is, specifically our clients and people that usually come to us that are interested in being clients are either retired or they're a few years out from retirement. So that's one of the big questions that we consistently get is it's, part of it's, can I retire? And if so, what does that look like? But part of it is,
Right.
If the world ends tomorrow and I want to retire, what does that mean for me? So us being able to show people, yeah, exactly. Us being able to show, this is where you currently are. And, this is kind of the projection of what that would look like if we were to experience those two really terrible back-to-back years and the really bad timing of that. And I think it's cool because I think that it really does help give people a little bit of peace of mind, especially if they have that firsthand emotional experience of living through that time period.
Yeah. As recently as 2019, which, now I realize isn't all that super recent, but that was the last time I remember getting the direct question. I cashed out in 2008. Is it safe to get back in the market? Yeah,
Yeah.
you know, the ripple effects, the after effects, and there is some pretty good research on folks who are maybe 7 or 8 years older than you. So who are maybe, later teens, maybe just getting ready to leave home during the great financial crisis, or were just getting out of college and looking at the abyss of a job market at that time,
Hmm.
and the effect that that has had on their financial attitudes in terms of like risk profiles, how they invest in their 401ks, and kind of like the Great Depression. And this is where I've seen some people where that gave them the attitude of they had to hold on to every penny they had because it could easily be taken away. And other people who responded to that by saying, well, it's just money, it comes and goes, so I might as well spend it.
Hmm.
Everybody's psychology is a little bit different, but I've seen that research with that generation that some people reacted by saying, well, I'm not, why bother to save for retirement? My parents lost all their 401k money, I'm not even going to bother. And others
Yeah.
who put a lot of money away but will not invest or take any risk with that money.
Yeah,
So
absolutely. And I
so
think
it,
part
it's
of it
going to
too that's
be.
interesting is when you look at culturally, because I know that I have friends whose parents are, who are from the old Soviet republics and who grew
Hmm.
up in the Soviet republics,
Oh
and
yeah.
so they don't have a great trust in the banking system in general.
Hmm.
So if you already don't have a lot of faith in that, it's really difficult to get somebody to take that nest egg and to put it into the market. I mean, there's
Right.
so that mistrust of the institutions can be a
Yeah.
really big thing as well.
When we decided we were going to talk about this a couple weeks ago, I went back and was like, okay, do I make a timeline of events? And, really at this point, all of it just kind of jumbles together into one like blur of a lot of work and a lot of stress. Um, I think the main things that stick with me. One is that what sets it apart in my mind is what you're talking about there with the people that left the Soviet Union, or I've talked to folks who are South American immigrants, where their experience with economies was Venezuela, and possible seizure of assets and that sort of thing. What sets the Great Financial Crisis apart from other events that I actually started my career in the middle of the tech bubble crash, which seemed really bad at the time, but it was a more market-based, rational market correction compared
Hmm.
to an existential crisis where we were worried about the institutions themselves not surviving. That was the big thing for me. As an advisor, you'd have a client come in and they're down 10 or 15%, and you talk through it and you do your best, and they'd agree, okay, we'll leave it alone, and things will come back. And then 2 months later you'd have the same conversation with the same person, but they're down another 10%.
Yeah.
And that, just the way that went on, and you'd go back and look at your notes like, gee, they were just in 6 weeks ago and they've already lost another chunk since then. What are you going to do? You can be the most stalwart believer in the system and the markets, and you start to kind of lose your religion after a while. I was lucky. I had a pretty good network of a couple other advisors, and we'd call each other at 4:30 in the afternoon after the market closed, and the equivalent of little group therapy.
Yeah.
And
Yeah.
but you just start to feel like you're the one making the mistake, and acting on those fears starts to seem more rational the worse things get. I remember hearing that treasury bills were actually trading at a guaranteed loss at negative yields, meaning people were willing to buy short-term government bonds knowing they were going to lose money on them because everything
Hmm.
else was worse. And that was right before like the TARP program rolled out, and government intervention to kind of shore things up. But essentially that was telling us that banks were so scared of where things were that they weren't even going to loan the bank next door money overnight because they might not be
Sure.
there in the morning. I remember just finding an excuse to go somewhere for the rest of the day that day because I couldn't wrap my head around around things
Yeah.
being that bad. As an advisor, you start finding little tricks like, okay, I'm just not calling anybody back until after the market closes. Those bad days would be going on and the phone would be ringing and you'd be busy and you'd be talking to people, but you'd have a pile of calls to return. And if you did it during the market, while the market was open, it was a lot more tempting or a lot easier to give in to, like, okay, if you really want me to sell this and get you out of it. But it was a little easier. It was especially easy on Friday afternoon because you could be like, well, the market's
Like the
closed
weekend.
and won't open again until Monday. So I'll tell you what, call me on Monday at 9. You think it over the weekend. A lot of times just that little bit of time to sit down and kind of reflect on where things were was all it took. And I remember doing things like, okay, what is the least amount we can sell from this investment that's, not in these words exactly, but what's the least amount we can take out of the markets for you to still be okay, you know? That's
Yeah.
going to give you enough money in your pocket to sleep, but I don't have to feel bad about the fact that you may not recover, because that was always the trade-off. And everybody's looking at their financial planners and advisors to say, okay, take the money out now and we'll put it back in when everything's better. Well, when everything feels better, it's going to be
It's
too
too late.
late. And that's another, like, of the main lessons of the financial crisis was trying, and this part's a little harder now because we've got a little more distance, but the market bottomed out in early March 2009, but
Hmm.
the situation, if you will, the crisis itself didn't bottom out until almost a year later. We were
Sure.
still getting an avalanche of worse employment, worse banking news, more defaults, more mortgage, it just the news kept getting worse. But at a certain point in March of 2009, the market actually had hit its bottom and started to come back up, but there
Hmm.
was no all clear signal. There was no, like, okay, now today's the day. This was the bottom. And that whole every
Yep.
time the market would go up a couple hundred points, we'd all be like, okay, but it'll just go back down tomorrow. And but at that point, it had kind of done its thing. Market technicians call that capitulation. It's a way of saying, like, everybody has to give up hope. Everybody's got either you've given up hope and you don't care anymore, or every time there is a bounce, so you're going to sell, right? You're just waiting
Yep.
for a little improvement, then you're going to get out, and we're right back where we started. And so you kind of need that. You need the last bit of hope to get wrung out of the system in situations like that.
I think another thing I think about too is, and you just mentioned it, it isn't like when you find the bottom of the market that everybody blows the whistle and says like, "Yay, we found it!"
Yeah.
Right? So
Yep.
I think that it's an interesting dynamic where there are plenty of people who, even as retail investors, are pretty apt at when things are going to go south, and
Hmm.
you have a decent nose for that. But the problem is that almost nobody has a great knack for when to get back in. So you
Yeah.
can
It
sell at a decent
actually.
time, but
Yes.
then you're never getting back in at the right point, which that's the other half of the equation. So it bottomed out in spring of '09, but the S&P had fully recovered by the spring of 2013. So
Right.
you talking about people asking you in 2019 if it's like, can we
Oh.
jump back into the party
Yeah.
now? Like we're way,
Yeah.
way too late for
Yeah.
that.
Yeah.
So, and that's why obviously here we're not big advocates of market timing.
One little anecdote that stuck with me and meant a lot to me at the time was in late 2008 going to meet with an older client who was he'd been retired for a while at the time and he'd been a businessman and very astute as far as individual investors go. And we were having this meeting, and I was like, oh, this is just how is this going to go? I was really nervous about it. And we sat down in the office in Indian River, and he just looked at me and you look nervous. And I said, well, it's been a rough couple weeks. And he just laughed and he said, well, I'm just glad you're willing to sit down within punching distance. And I looked at him and he said, I know with what you're going through, everybody probably blames you. And, all we really need is somebody to kind of own it and remind us, why we're here and what we're doing. And it's funny, I mean, he probably didn't even think about it when he said it, but I'll never forget that. It was an extreme situation, but to his point, none of it was outside the realm of the possible that when you talk to clients, when everything feels good and everything is okay, you talk about the potential downside, but people have no context for it. you
Sure.
know I guess the other thing, like looking back at the time, I'd never had a lot of formal training on like behavioral finance, and I have since. And it's fun, like thinking back on those conversations and those times and seeing like all of the financial biases on display, recency bias and action bias in particular. But with recency bias is that feeling
Anchoring.
that, yes, yeah, anchoring, and that it's always all like whatever trajectory it's on right now is the trajectory it's going to be on forever. So like it's
Yep.
just never going to get better once it starts getting
Yeah.
bad, which is the same thing that happens on the good side during bubbles,
Yeah.
right? It's only going to
Exactly.
go up. So
Yeah. Get
so
your
that was
tulip
that.
mania.
Yeah, yeah. And well, and the big thing from an advisor standpoint was action. People want you, like the amazing thing to me was, so I came up with a little list, and we've talked about this before, but actions you can do during a correction or a bear market where you're doing something but you're not necessarily hurting the portfolio. So, when people would come into the office, their idea of action was get me out of this, right?
Hmm.
And my reaction to that is, well, if we sell it now, you're never going to make your money back. But maybe if we let's rebalance, or let's change your dividends to reinvestment, or let's do these little micro actions that maybe make you feel like you've done something proactive. You're not just sitting here watching your portfolio plummet, but you also haven't really hurt yourself for the long run in the way that doing what you meant to do might have done. So
Sure.
another other examples would be like if people had a after tax portfolio and an IRA, or an IRA and a Roth IRA, we might lower the risk in one with the idea that, hey, that's the account you're going to use, so let's you know make that a little bit safer for now, but let's take this other account that you're not going to touch for 10 or 15 years, and let's take on more risk there, so that overall you're not selling in a bad market, you're just switching where you
Hmm.
own the things like that. It scratches the itch without giving in, if you will.
Sure.
So
Yeah. Well, I've always been interested to know. I'm assuming during that time that a lot of your clients, understandably, are in the "get me out of here, the house is on fire" type of a mindset.
mhm.
But did you have some clients that were not only on the let's hold type phase, but were the "I've got some more cash in the bedroom drawer. Can we get some more action?"
There were a few. There were a few, but they were few and far between until like sometime, I want to say when the Dow got down below like 7,500, which is just sounds ridiculous right now when we think about where the markets are. There were people that were like, oh, at this point, go ahead and why don't you take me from 60/40 to 70/30, add some
Hmm.
stock. Nothing extreme, but that seemed to happen more right around the time that the market did bottom out. And of course, I didn't realize it at the time, but that was part of it, like in the macro sense that, as
Sure.
an as a investing public, people were just at the point where it can't keep getting worse. All the ones that believed it was going to keep getting worse were in cash a long time ago.
Sure.
So yeah, I don't recall a lot like in 2008 who were anxious to put more money in. The news was just so bad. It
Sure.
is funny though that those same people, because I had some of those clients, I still have some of them today. In 2020, during the COVID crash, I did have more of that, who were like, "Oh, we've seen," it
Sure.
was like this, "Oh, we've seen this before. It will recover," and that
Mhm.
wanted to go, particularly in like longer term portfolios, like in their Roth IRAs or things they weren't drawing from. We're like, "Oh yeah, now's our opportunity. We've seen this movie."
Yeah.
And I remember, and I remember in 2020 going, yeah, but until we have a vaccine and know how these government programs are going to play out, I just don't know.
Yeah.
But
But then there was the quick bounce. It was like a month.
yeah,
And then it
yeah,
was,
yeah,
and then,
yeah, yeah, yeah. I do have a
yeah.
few
So
who were very brave early on there.
yeah, it's funny you saying when the Dow was at 7,500 because today it's at 45,000.
Right,
So it's, you know
right.
what I mean? It's funny how,
Yeah,
you know, compound
yeah.
interest, but
Yep.
yeah, no, that's it's really interesting, and I don't know, like there's been obviously different timelines, everybody's different risk preferences and things like that, but anytime I can find somebody, and sometimes like there are people that might surprise you. Like I've heard
Hmm.
stories of, you know, kind of the young, savvy business person that in those moments gets really nervous and wants to, you
Yes.
know, de-risk. But I've also heard stories of the little lady that's like, all right, let's like crank this thing up.
Well, and whatever, we do risk profiles and we have documentation in the files for everybody, but when the stuff really hits the fan, you can throw those things out the window for the most
Hmm.
part. you know
It's the
um,
Mike Tyson quote.
you can't count on it once the emotions get to a certain point. Rationality
Sure.
goes out the window.
You know, just for a brief historical overview, because I'm always curious to you know, go over people's first recounts and memories. And a lot of the people I talk to this about aren't professionals. It's just like friends and relatives that live through it. But, you know, give me your rough '07 to '09 timeline, the big events, you know, what you remember maybe from some of those more impactful days, like, you know, Lehman Brothers and things like that. And
Lehman Brothers, when that news hit that morning, I was actually going to Canada on a extended canoe trip with with another investment advisor and a few other folks. I remember the other investment advisor and I are standing there by my mailbox loading stuff into the truck that morning at like 6 a.m. With the news coming in overnight, and we just looked at each other and like, can we leave? At first we were like, what do we, we were both like, what do we do? Do we, we'd had this vacation plan for a while. Do we go back to the office? What do we do? And at the
Mhm.
end we were both like, you know what, if we're gone for a couple days, that's probably the best thing for our clients. you know
Yeah.
and
Yeah.
sure enough, it was a good time to be out of radio contact for a while, for a couple days. That
Absolutely.
one sticks with me. Like I said earlier, the rest of it is just such a blur. Personally, we had been trying to sell a house and do different things at the same time, and it was one thing to go and be like nerves of steel at the office and this is all going to be okay, and then I'd come home and be like, oh crap, what are we going to do? We're going to end up with two houses, and never going to recover from this. And
Yeah.
trying to separate the two or not separate the two in some ways, try to treat
Yeah.
myself the same way I would a would a client was a learning experience too.
Yeah. No, I think it's obviously much easier said than done, but it's the Warren Buffett quote that when the tide goes out, you see who is skinny dipping. And
Who's
I think
yeah,
that
right.
in the yeah, I think in the investment world we think about that as people being, you know, like overly levered or things like
Yeah,
that. But you know, even for regular
yeah.
people in the real world, you know, there's something to be said for emergency funds and for, you know, not carrying too
Hmm.
much debt and things like that. And I know that obviously what we're going over with our clients in our spring meetings is talking about lifeboat drills. You know, the next time that there is a, you know, a really rough year in the market or maybe a rough couple years or whatever. And I think just having those things in place ahead of time and being
Yeah,
disciplined and, you know, having savings, things like that, I mean, that goes a long way. Because
yeah,
if you don't need to tap into, you know, stocks and bonds when the market's super down, then it greatly increases the chances that you can just hold and
right.
you can just wait and things are going to get better.
if I look at what the impacts of that time were on my career, that's one of them. I'm faster than most of my clients to say, oh, wait a minute, if you're putting that new roof on the house next year, we're putting that money in the bank today. You know,
Hmm.
that's not doesn't belong in the market, because I don't want to be here with the materials showing up and the crew there to work and the market's down 25% and you're wondering how to pay for it. Um,
Yeah.
and so I tend to be very conservative in that way. I think more, though, it probably colors how I talk to clients during the good times. I end up sounding a little silly, but it's like I'm always waiting for the next shoe to drop.
Hmm.
But I find that talking about corrections and potential downturns in the market more often helps it not be a surprise when it happens,
Yeah.
and to remember that those odd events are still part of the equation and the expectation.
Yeah. Well, and I think part of it too is just talking about and making sure the clients are familiar with the fact that, like, recessions are normal and frankly
Yeah,
kind of healthy for the
yeah,
economy. It's like to be
right,
expected. I mean, if
right,
anything, a recession a lot of the time is almost like an economic hangover. Like we've been
yeah,
usually, and I've read Morgan Housel read about this in one of his books, but he's like, kind of the business cycle is everybody gets really excited, takes out a bunch of debt,
yeah,
really runs everything up, valuations get really high. People think that the valuations are too high. They start selling, everything crashes. People don't trust the market, and it's kind of
yes,
this
boom
big
and
circle.
bust. Yeah,
Yeah, that's exactly what it is. And so it's to be expected. And hopefully we don't have another '07 to '09, but there will be in the future. Like there's going to be a
oh
recession.
sure,
So the more that
yeah,
you are just aware of that, and are, I guess, going to help your personal anxiety and just your general
hmm,
monetary comfort in that moment.
yeah, yeah. I guess I would close by saying to the two other things that will stick with me is, one is the system is extremely resilient.
Hmm.
And ultimately, to come full circle where we started, those institutions survived, and if they can survive that and be better for it, there, what it would take a lot to really change that. And the other thing is that people are adaptable, and I saw that people are resilient and adaptable as individual investors and in their financial lives. People were able to adapt their spending, change how they were doing things in the moment, that probably made a bigger difference than anything they did portfolio wise. Being able to say, okay, yeah, we'll take that vacation next year instead of this year, or
Hmm.
we'll do that project at a different time.
Yeah.
So
Yeah, no, I think that makes a lot of sense. I've heard you talk to clients about that before too, and I think that it's easy to get married to this idea that this is always the amount of money that we need, and we always have to have this
right,
and whatever. But I think that, especially in the short term game, especially for people that are retired that have lived through difficult times, you can adjust and things will be all right as
yeah,
long as you stick to
yeah,
the basics.
yeah, yeah.
Yeah, absolutely. Well, unless you got anything else, I
Well,
feel more educated.
I think I'd just start repeating myself at a certain point. So
There you
no,
go.
it's
There
good.
you go.
We should never forget those kind of instances, though. I think that's the big thing.
Yeah, I mean, history repeats
Yeah.
itself, right? That's why you got to keep the books for as long as you do. Got to keep them sitting there on the shelf to remind you.
That's
But
right.
yeah, well, thanks for doing this with me today. I appreciate it.
All right, it was
Hopefully, I
fun.
did a pretty decent Nick Nada impression.
Yeah, you did. You
And
did. You filled in for Nick pretty well. I think we'll be all right.
I try. I try. Well,
All
awesome.
right.
Well, I'll talk to you on the next one, and take care.
Great. Thanks, Cole.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.